available between 1 and 2 and 3 and 4 today. There is a link in Canvas that will allow you to attach your spreadsheet, to upload it to Canvas, because that'll make it easier for me to grade. If you don't know how to do that, just ask me, I'll show you. It's not that hard. But I like that I can pull it up on my big screen in my office where I can see, and I can grade it that way. And again, don't forget to answer the questions. You can do those in Excel. You can type them at the bottom if you want. You can attach a Word document too. That's entirely up to you. I don't care how you give those to me. So we're going to start chapter 9 today. We're actually going to finish chapter 9 on Wednesday. We're going to start chapter 10 on Friday, finish chapter 10 on probably Monday, and then we're going to have an exam next week. Wednesday or Friday, I'm not sure yet what day. The reason that we're having an exam next week is because I want to make sure we have enough time to cover what we need to cover for the final. And the final is only on 2 chapters. So I like to kind of lighten up the load during finals. So we've had a consistent 3 chapters per exam, but the final exam will only be on chapters 11 and 12. And sometimes I don't even get through all of 12. So it's just, kind of play it by ear with chapter 12. So yeah, we're plugging along here. We're right on track. Chapters 9 and 10 also deal with budgeting, so that's why I do 8, 9, and 10 together. Get all our budgeting in and out of the way at the same time, I guess. All right, so that's kind of the plan for the upcoming weeks, and so make sure you're thinking about that and trying to plan accordingly. All right, so in chapter 8, and I like to make sure we understand the links between all of these chapters. So chapter 8, we really looked at doing schedules and individual budgets that all kind of play into creating those 3 main budgets, which really end up being the cash budget, which we did in chapter 8, right? The balance sheet budget, which I didn't even really show you, and then the income statement budget. Also didn't really go into great detail. Okay, this is going to be the focus. The income statement is going to be the focus of chapters 9 and 10, actually. Okay, because it really describes for us performance, and who's not interested in performance, right? As far as your academic performance, your athletic performance. If a business wants to know how well they did, and did they do as well as they expected to do, and if not, why? So we're going to be looking at the how and why here in chapters 9 and 10. We're looking at a very basic income statement, but I need you to understand that all of those schedules and budgets that we prepared in chapter 8 all feed into these 3 budgets. You guys got to see how those budgets fed into the cash budget, right? If you think about what's on the balance sheet, we have assets, liabilities, and equity. Okay, and if we go back through our budgets, we could identify some of those things. Not all of them were in those budgets, though. The income statement budget is simply going to be a list of revenues and expenses, revenues minus expenses. And most of those came from a budget. Our sales budget really would tell us how much revenue we expected to collect. And then we had various expenses that we planned to incur throughout those other schedules that would also feed into this income statement budget. Now, for time's sake, we're going to really kind of just look at a budget already, I guess numbers already provided to us, okay? All right, so something called flexible budgets and performance analysis. We want to know, how did we do, right? All right, so the term variance analysis is going to be used in chapters 9 and 10. And if you like managerial accounting, you like cost accounting, you get into more of a private accounting career as opposed to public accounting, this term is used very, very widely. The word variance is a fancy word for difference. That's really all it means. Remember in accounting, I said we sometimes take words that mean something in our normal everyday language and we give it a different meaning in accounting. This is one of those words. So a variance means difference. And what we're trying to determine here is, okay, I had created this budget. Now let's compare it to what actually happened and see if there are any differences. That's all we're going to do. We call those differences variances. So we're going to be creating what we call a report. And that report allows us to analyze what happened. All right, we're going to call it a performance report because it's going to answer for us, how did we do? All right, so when we create the very first budget that we create, we call it a planned budget. So let's just say, for example, let me kind of set the scenario for you. Let's say that it's May and we're going to be looking at a guy named Larry. He has a lawn care business. And he's excited because summer's coming, I think. Maybe one day this week, and then it's leaving again, right, temporarily. But anyway, Larry's trying to anticipate how much money he's going to make over the summer cutting grass. So in May, Larry is going to try to plan a budget for June to determine how much revenue he'll have coming in and how much expenses he'll need to pay. That makes sense, right? The initial or the first time Larry prepares that budget, he calls it a planned budget. Okay? So it's the very first budget that we do. So if I asked you guys to do a budget for me for your summer, tell me where your income's coming from, tell me what all your bills you think you're going to pay for the summer, that would be a planned budget. Okay, if you did it right now. Now summer's not here yet, right? So it's just, this is your plan, a course of action. That's all it is. So we call that initial budget a planned budget. The problem with planned budgets, or any budget that we never look at again, or we never update or modify until the end of our budgeted period is over and we try comparing it to our actual results. So for example, if you guys created this personal budget for me today, you set it aside, summer came and went, and in August, you guys have your actual results from the money you made and the money you spent in the summer, and now you're going to take that and compare it to the budget you prepared in April. Okay? The problem with that is that between April and August, some things probably changed, right? Some things probably changed. I use the example, let's say that you currently have a job lined up for summer and you know how much you're going to make. Okay? Well, let's say about halfway through summer, you get another part-time job. That's more income than you originally expected, right? You should go back to your original budget and do what to it? Update it to include this additional income that you hadn't planned on in April, right? But let's assume you don't do that. You never look at that budget again. So at the end of summer, your planned revenue is going to be very different from your actual revenue, isn't it? Okay, and what's the problem with that? What's the problem of never, making a conscious decision to include that in your budget? Additional income. Specifically, additional income. What's the problem with that? Any ideas? Like, I know for myself, if I'm teaching an extra class, I know exactly how much extra income that's going to be for me, and I know exactly what I plan to do with it, because I usually save it or plan it for some project that I wouldn't have otherwise had money for. But if I didn't plan for that, what would most likely happen to the extra money that I made from teaching an extra class? I don't know, right? I'd spend it, wouldn't I? Because it would just kind of melt in with the rest of my money and I probably wouldn't think anything of it, right? So if you make a conscious effort to highlight it, to identify it, right, then you can plan better. So you see the apples to oranges up here. Comparing a static budget. So the word static means not changing, right? The static budget is also, or the planned budget is also called a static budget. If you never go back and update it or change it to accommodate or align with the things that are going on in your life that affect that budget, then it's pointless, right? It would be pointless if I asked you to create a personal budget today for summer and you never looked at it again. It would be absolutely a waste of time, okay? So they're saying that's like, if you prepare this planned budget and you never make changes to it and you wait until your actual results are in and then you compare your planned with your actual, it's like comparing apples and oranges. We will see a little bit more of what they mean by the apples and oranges a little bit later on. We can't evaluate our performance that way. We cannot evaluate our performance that way. All right, so we're going to be preparing something called a flexible budget. It's actually pretty simple. It just means that we are flexible as people. Anytime we are made aware of a change that would be contradictory to something on our planned budget, that we're flexible enough to go back to that planned budget and do what? Change it. That's all. And with today's technology and the spreadsheets, how hard is that, folks? You guys are working on that assignment for me. How hard is it to change the selling price from 8 to 7? It takes like half a second, literally, right? And what happens to the rest of all your spreadsheets? They all change, they all update it, yes? But if you're not willing to make that change, you're not willing to be flexible, right? Then you're going to have a difficult time evaluating your actual performance, how well you really did. If you don't include that extra income over the summer in your planned budget, you don't go back in and include that, you're not going to be able to really evaluate your performance over the summer, right? As far as your money is concerned. Okay, so we're going to, these budgets are kind of nice because they're very similar. If you think about the Excel spreadsheet, in the requirement, I think it was requirement number 2, you guys had to go in and change your unit sales, right? You had to change your unit sales and then kind of see what happens. That's your planned level of activity, right? That's what we mean by flexible budgets. You can actually go in and change the numbers and everything else will change after. Now, we're going to be doing it manually up here, but if you think about how nice Excel is for that, that would be perfect, right? A perfect solution or a perfect tool to creating a budget where if something changed, you want to be able to update your budget easily and conveniently. And that's what Excel does for us, okay? So let's take a look at an example here. It also helps you control costs, right? Because if you're made aware of an increase in a cost, for example, if you guys are doing that personal budget today and you don't have the purchase of a car or a car payment in there, and all of a sudden in the middle of summer you find yourself buying a car, you don't go back and update your budget, you're going to have difficulties sort of adapting, right? Or perhaps planning for that additional expense that you didn't have when you first created your budget. So we got Larry, there he is on his little tractor, he looks happy, huh? If we freeze right now on the tractor, you would have to wear a winter coat, hat, and gloves. At least I would anyway. Okay, so Larry's Lawn Service provides lawn care in a planned community. So, you guys know what that means, I hope. Where all lawns are approximately the same size. It's like a development, gated community, something like that. At the end of May, Larry prepared his June budget based on mowing 500 lawns. So maybe there are more than 500 lawns in that community, but Larry doesn't necessarily service all of them. There are other lawn guys around, right? So maybe that's how many he serviced last year, or maybe that's how many, that's how much interest he's had from customers, current customers who maybe called him up and said, we want to sign you up for some services over the summer, okay? But why is he preparing this in May? Because he's trying to figure out what's going to happen in June, right? So he knows how much money he's going to make and how much money he's going to have to spend. Since all of the lawns are similar in size, and saying that all the lawns are similar in size makes our life easier, by the way. I'll tell you why here in a minute. Larry felt that the number of lawns mowed in a month would be the best way to measure his overall activity for his business. Because if that's what he primarily does, mow lawns, then that's going to be what drives his revenue and what drives his expenses. Okay, cutting grass. All right. So how does Larry come up with the numbers for his budget? Well, here's how. This is just the income statement, by the way. Just the income statement, by the way. So Larry's going to use historical data to help him do this. He might use some data from some of the other budgets. Now, this is a service business, though. So you have to keep in mind, Larry's not going to have a direct materials budget, right? He's not going to have a production budget. He's going to have a couple of budgets that were similar to the ones we did in Chapter 8, but he's offering a service. So he's not going to have, like I said, production budget, materials budget. He might have overhead. He's going to have some overhead here. He has some shop utilities and rent and things like that. Selling and administrative expenses. He's not selling a product, so he might not have selling expenses per se, right? So it'll be a little bit less involved for Larry because his business is a little bit more simple. All right, so these are the formulas that Larry uses. And, kind of going back to algebra here, not to scare you, but it's really not that hard. Larry is going to plan his budget on the number of lawns that he's going to mow. And he's going to refer to that number of lawns as Q, variable Q. So right now, Q is 500, okay? This is in May. This is just the information he currently has. He charges $75 a lawn. Why can he charge the same for all lawns? Because they're all similar in size. That's why so yeah, see, this is how we simplify our examples here, right? We say, okay, all lawns are similar because if they weren't, then maybe, this person's property is 3 acres, this person's property is only a half an acre. Obviously, it's going to be more expensive to service the larger lawn. There would be different prices. We don't want to get into that yet, right? So we're going to assume they're all relatively the same size. So in order to figure out how much money Larry might make from servicing 500 lawns, he simply takes what he charges, $75 per lawn, multiplies it by Q, the number of lawns, and he gets $37,500 in revenue. That's just what he expects. That's what he's planning for. Then Larry goes through and he says, these are the expenses I typically incur in offering my service to my customers. The first is wages and salaries, and you'll notice here this formula. It says 5,000 plus 30Q. Now, that formula has two components, two different types of costs. What are they? You guys got to go back to chapter 2. Fixed and variable. Which cost is fixed? The 5,000. No matter how many lawns, right, being serviced, right off the top, and maybe Larry's salary's in there too, $5,000 for salaries. But there's also a variable cost component here, and it's plus 30Q, right? So the number of lawns, Q, times $30 is the variable cost component. When you are putting this in your calculator, and I have to say this because I always have a student who doesn't do this right and gets it wrong on a test. What is the order of operation here? I need to do this multiplication first before I add the 5,000. Do not move left to right in your calculator, right? Unless you have one of those fancy calculators where you can add parentheses to it, right? And then identify the order of operation within the formula, I guess. If you're just using a regular calculator, but you don't need a fancy calculator. Make sure you do 30 times 500, hit your equal sign first, then add the 5,000, all right? Otherwise, you're not going to get the right number. So 20,000, this is a mixed cost, right? This is a mixed cost. Gasoline and supplies, 9Q, that is a variable cost, right? And that makes sense because the more lawns Larry mows, the more gasoline you'll have to put in his lawnmowers, correct? Yeah, okay. Equipment maintenance, the more lawns he's servicing, the more equipment and maintenance on that equipment. All right? Office and shop utilities, this is a fixed cost, right? Doesn't matter how many lawns Larry mows, that's hard to say sometimes. Doesn't matter how many lawns, $1,000 is probably his budgeted utilities for the month, all right? Rent's $2,000, depreciation's $2,500, insurance is $1,000. Those are all fixed as well. Does that mean that none of those expenses could increase for Larry at a given time? No, it just means that if they do increase, it's not because of what? The number of lawns. Perhaps Larry's insurance premium renews every June. And right now he doesn't have his new premium. But maybe when he gets his new premium in the mail, the insurance company is sorry we raised our rates, right? That has nothing to do with the number of lawns Larry's servicing, does it? Okay? And budgeted utilities. I just got to notice that my budgeted gas bill's going down like, I don't know, $5 or something like that. Okay? Why does that happen? Because the rates change, right? That sometimes depends on weather and things like that. You don't know about it until you get notified. So you might be planning using an old number, right? And when you get the new number, you'll update or adjust for that. All right, so when it's all said and done, Larry's expenses $32,500, $37,500 minus $32,500. Larry plans to make about $5,000 in the month of June. Okay. Everybody with me? All right, perfect. Now, June comes and goes, and now Larry says, these are my actual results. Now, I need you to understand something. The formulas are not used here. Why not? Because these actual results come from receipts that Larry gets in the mail, actual bills that come in the mail, a total of all the revenues, the bills he sent to his customers. Okay? This isn't based on a formula. That formula was just used to help him plan. So when is Larry going to be able to put together this actual results income statement? Probably not until after June is over. Why? Well, for example, the electric bill, right, is based on your usage from during your billing period. So if Larry's billing period, let's for convenience sake say is June 1st to June 30th, he's not getting a bill until July, right? So he doesn't actually know what his insurance or what his electric bill might be, right? Now if it's budgeted, might be the same, but if that budget changed, he won't know that until July. That's my point. He may not be able to add up wages and salaries until July because of how his payroll runs. So he's really not going to know his actual results for the month of June probably until a couple weeks into July. So then he's going to take the actual results and do what? Compare them to his planned results. But throughout the month of June, what realistically could happen for Larry? Larry said I get 500 customers before June even happens, but what could realistically happen throughout June? So like when I moved into the house I currently live in a number of years ago, my husband is like an outdoorsy person, and he likes gardens and green grass and all that good stuff. I get yelled at if I drive along the edge of the lawn, and my tire track is there, and I'm like, oh, but you can leave the bathroom a mess, but you don't want me driving over your little edge here of the lawn. Anywho, it's real particular, So our neighbor's lawn looks like carpeting. I'm not kidding. Like, this guy spends like 15 hours a day, on his lawn. He's very meticulous. When my kids were little, I was always like, please do not let the ball go in his yard, because then there would be footprints or something and he would know. So my husband was like, who do you use for your lawn service? And then what do you think we did? We use the same people now. So don't you think that can happen for Larry? So maybe Larry planned on 500, but he does a good job. Other people in the neighborhood perhaps weren't happy with their existing lawn service care, and so they say to the neighbor, hey, who's that guy? Your lawn looks great. Who does your lawn? And now Larry has 550 customers, right? So throughout the month of June, Larry got more customers. At the end of June, regardless of whether or not Larry knows all this other stuff, right? On the eve of June 30th, Larry could pretty much tell you that he had 550 customers, not 500, right? Throughout the month of June, there was a point where Larry had already serviced maybe 20 more customers, right, than he expected to have. My point is, what should he have been doing throughout the month of June to his planned budget? Adjusting it, and he didn't, okay? He did not do that. These are his actual results. Larry didn't do that. Larry's learning just like we are. So, Larry decides to see how well he performed for the month of June. So he takes his planned budget, here's the apple, right? Okay, but his planned budget is only based on what? 500 lawns. That's like comparing apples and oranges, because the actual results are based on 550 lawns. Now, do not be confused by the formulas over here. Those formulas were only used to compute the planned budget. They're not used to compute the actual results. The actual results are the actual results, right? They're not based on necessarily a formula. They're based on what actually happened. The formulas are only used to project what might happen. So we have this column called variances. Another name for that is differences. And we're identifying the differences between our planned budget and what actually happened. Now, you'll notice these labels, and I jokingly say this is the only time I can say F you and not get in trouble. Thank you. No one smiled in the other class. They're really tough, though. I was like, wow. I would never say that, but anyway, F and U stands for favorable and unfavorable. Okay, so we're looking at what did we plan for and what was our result. If what we planned is better than what we thought we were going to have, it's favorable, right? And it's not necessarily good or bad. So let's kind of talk about that. In this case, he had actual results. He had actual revenues of $43,000. But he also serviced 550 lawns. That revenue is higher than what he planned for. But should it be? Well, yeah, because he serviced 50 more lawns, right? Of course. Okay? So that's a difference of 5,500. That's good. That's favorable, right? When you're looking at expenses, though, going the opposite way, your actual results are higher than your plan. That's not favorable, is it? That's unfavorable, because that means you spent more than you planned to spend. Now, it's not always necessarily a bad thing. For example, wages and salaries actually were $23,500. So Larry literally paid his people $23,500 in June. He had only planned to pay them $20,000. But why does it make sense that he would have had higher salaries and wages? More hours, more lawns, right? He had to pay people to service those additional 50 lawns. So I'm not necessarily concerned about that. See, the idea of the variance column is for management to look at performance and to identify whether there's something there they need to be concerned about or to look into further. That's all it is. And you're not going to look into every single item on this list. And you'll see when we get to the next section of this, it kind of makes a little bit more sense. But just because something is unfavorable doesn't mean that life is over and you should give up and go into business somewhere else, right? So if we come down here, gasoline and supplies. This was based on Q. Well, Q is higher now, isn't it? So we service more lawns, of course we're going to use more gasoline. Again, I'm not concerned about that, right? Even though it's unfavorable. Look at equipment maintenance. Well, we expected based on the number of lawns, and it's typically $3 a lawn, but maybe our equipment's in tip-top shape and we actually spent less than we thought, okay? That's favorable. Notice my utilities came in only at $950. Perhaps one of those budgeted amounts went down this month, right? Okay, nothing, we're not too worried about that. The rest of these, these two, I'm sorry. Rent and depreciation stayed the same. Insurance went up, but it's not because of the number of lawns. It's because the insurance company raised their premiums. Or perhaps Larry said, I want more coverage, or I want a different type of policy or something like that, but it doesn't have anything to do with the fact that he mowed 50 more lawns, okay? When it's all said and done, here's what we do. We take all of our favorables and our expenses. So we have this up here, and we do the same thing, revenues minus expenses. So when you're adding up all of your expenses, you take your favorables and you subtract your unfavorables. Or in this case, your unfavorables subtract your favorables, whichever's higher. The net result is unfavorable $4,050. You can also do it this way. These expenses added up minus these expenses added up. 36,550 minus 32,500 is 4,050. It's unfavorable because your actual expenses were greater than your planned expenses. Okay, that just to think logically about that. And then you had favorable revenues were extra 5,500. Expenses were an extra 4,050, but that's higher than that, so you're favorable to the tune of 1,450. Okay, now, this is not ideal, right? Because we're comparing apples to oranges here. What would have been ideal is at the end of June, okay, before Larry even had the rest of his results here, because he wouldn't have known all this yet. He would have known this, though. He should have come back to this planned budget and recalculated all of his numbers using 550. That's what we mean by flexing the budget. So let's see how Larry's getting the hang of this, okay? And I'm skipping over some of these because I'm actually talking about what's in them. So here's the question that's super important. So I want to make sure we focus on this. It says, how much of the cost variances or how much of the differences are due to higher activity and how much are due to cost control? So in other words, let me go back here. Salary and wages. I cannot answer that question right now. I know that my salary and wages expense came in at a higher amount than what I planned, but I'm not able to determine at this point whether it's because Larry serviced more lawns or it's because he can't control his costs or his employees were maybe dogging it on a job and Larry had to pay them overtime, or perhaps they didn't perform the service and they had to go back and do it again, right? And they're getting paid twice now for that. We can't tell that here because I'm not comparing apples to apples. So I do not know if this variance is the result of additional lawns or some issue with cost control. That's why I have to flex the budget. And that means change the level of activity to agree with the actual level of activity and plug that level of activity back into my formulas. So you'll see how that works here. All right, so Larry is flexing his budget. We're just going to look at that budget just by itself first. In other words, all Larry's doing is he's redoing all of those calculations that he did with his planned budget. Okay, same calculations, nothing has changed except for Q. When Larry did his planned budget, what was Q? 500. Now Larry's going to do a budget and use 550. Now, this might be at the end of June, right? But that's okay. He still doesn't know all of his actual results yet. This is what we call the flexible budget. He's flexed or he's changed his level of activity to agree with the actual level of activity. That doesn't mean this is going to match up with his actual results, but it takes the question out of the equation of, is this a difference of activities or is this about cost control? Okay? So when we plug that stuff back in here, Q is 550, 75 times 550 is 41,250. We do all these other things. Look, Larry now expects to have income of 6650. All right, a little different than his planned budget, which was only 5,000. All right, now let's compare. I'm going to skip this too. Let's prepare what we call a performance report. There are several components to the performance report. I'm going to show them to you in 2 steps here. The first is a comparison of the planned budget to the flexible budget. We call it an activity variance because the only difference between the 2 budgets are changes in levels of activity. So here's where we're plugging in our formulas in both of these. Look, Here's my formulas. In this first column here, the flexible budget, I use 550. In this column here, I use 500. All right? The only difference in my costs, or not the only difference, the reason my costs are going to be different, though, is because of the $50 difference. That's what's making these different, just the level of activity. So I'm isolating that in this particular part of the performance report. I'm simply identifying the differences in my costs because of the change in the level of activity. That's it. All right? So we call that flexible versus plan. All right? That's what we call activity differences. The activity here is lawns being serviced. The difference is 50, right? And again, you got to do the same thing, favorable versus unfavorable. We'll have a look at that though together. Okay. Now, then I have to do the second part of this is I have to take the flexible budget, the budget that I adjusted to agree with the actual level of activity, and I have to compare it to my actual results. We call this revenue and spending variances because here's what's happening now. Here's my apples to apples. Look, I have taken out of the equation the different levels of activity, and I'm comparing now the same level of activity, right? One using the formulas that I created to plan for my budget, the other with my actual results, which I can't really gather, don't come in until the end of the month or even a few weeks after. So now, there is no question that any of these differences over here are the result of a different number of lawns being serviced because I'm comparing the same number of lawns, correct? Now we're comparing apples to apples. That's the idea. So look here, this revenue, $43,000 versus $41,250. The actual revenue we earned when I took out all my customer statements and I added all my billing together, right? My billings together, I got $43,000. When I used my formula, 75Q, I get $41,250. Did I overcharge my customer? I'm not going to say you overcharge your customer, I don't know. But if you're like my husband, you add on services to the ones that you originally scheduled. Oh, by the way, we have grubs, so now can you do grub treatment right while you're here? Because the skunks will come if you don't get rid of the grubs. Whatever. Okay? What's a grub? It's a little bug that skunks like to eat, and they scrape your lawn up and destroy your lawn to get to the grubs. This is what I learned. Yeah, anyway. So I don't know, but now I can figure, now I know it's not a difference in the number of lawns. I know that maybe a customer added on a service, right? Maybe I overcharged somebody and they didn't realize it and I didn't realize it. This is now going to help me figure that out. That's all. You can investigate that now. Okay, yeah, these 5 customers added on additional services. They wanted me to weed whack their, I don't know, whatever. Think any service, right, that maybe Larry provides up and above the $75 per lawn thing, right? All right, so now we come down to wages and salaries. Now, we know that the difference in wages and salaries is not the result of the number of lawns. So now I'm concerned. Why? Because I actually paid my people $23,500. I had planned to pay $21,500, and that was based on the same number of lawns that I actually serviced. So what happened here? Why did I pay $2,000 more to my employees than I should have? And again, that goes back to, the assumptions that I was making before. Perhaps somebody was dogging it and I had to pay overtime. Perhaps somebody didn't do the job right, the customer was dissatisfied and we had to go back and reservice the lawn, right? But now you can investigate and find out why and fix it for the next time. That's the idea behind this from a management perspective. And as you go down through the rest of those, you see the comparisons. So when it all said and done, see how much closer we are to being in line with what Larry expected or anticipated. Even though he's under $200, it's not that much money, right? And each of those individual variances may or may not create or force Larry to ask additional questions. But the point is he now knows, look, I actually spent less here gasoline than I should have spent. That's great, right? I'm sorry, no, it's unfavorable. That's not good. Okay, but it's $150. How big of a deal is that? I don't know. Maybe, gasoline prices fluctuate, right? And that's not easy to estimate or adjust for. He might just not even think anything of that. This $350, equipment maintenance, he's probably happy about that. Maybe he'll have a month where he has more maintenance than he expects. So these are not necessarily all going to create an issue for Larry. Now, I would think the revenues, though, and the salaries would force him to ask some questions. Okay? Now, everybody pay attention. We bring this all together. I just love this report. On the flexible budget performance report, all of this in one place. So let's take a look. So we have our labels down the left side along with the corresponding formulas. All right? We have our actual results. Please understand, everyone listen. These actual results are not computed based on these calculations. These calculations are only for your budgets. The actual results are based on the actual amounts you paid out, the actual amounts you received from your customers. They're not based on these formulas are only used to help you project what might happen. You have your actual results. In the middle, you always have your flexible budget. When you compare your actual results to your flexible budget, you get what we call revenue and spending variances. The difference between the revenue you earned and the revenue you thought you were going to earn, the expenses you paid, those you thought you were going to pay. What's taken out of this factor here is you're comparing apples to apples with the levels of activity. That's why we call them revenue and spending variances, because these are strictly about costs. Okay? Nothing to do with levels of activity. Always look at this from the standpoint, look up here. If your actual revenue was $43,000, your budgeted revenue was $41,250, that's favorable, right? Okay? Your actual salaries and wages were $23,500, you only budgeted for $21,500, that's unfavorable. So when your actual results are higher for revenues, that's favorable. When your expenses are higher, that's unfavorable. The opposite, right? Then you take your flexible budget and you compare it to that first budget you did, that planned budget, right? The differences between the flexible and the planned budget are differences because of your number of lawns in this case, of activities, levels of activity. Okay? So look, flexible budget, $41,250. You plan for $37,500, so that's favorable, is higher. Flexible budget of $21,500 versus a planned budget of $20,000, and ended up you had to make it higher, right? When you flexed it, that's unfavorable. See? So you've got your variances between those three columns, inserted between those three columns. There is an illustration in your textbook that actually takes these two and flip-flops them and puts these two over here. All right? I'm not sure why there's an inconsistency there. It doesn't really matter. Your flexible budget should always be in the middle. I don't care if your planned budget is to the left or to the right. It doesn't matter. But make sure that you understand if your planned budget's over here, then this column will be activity variances. If your actual results are way over here, this column will be your revenue and spending variances. Okay? So when you guys get to do an assignment on Wednesday, you can use this as an illustration. If you use the one in the textbook, please understand that those columns are flipped. That's all. All right? Questions, anyone? All right, let's start off and get down to business here with doing one. So we're going to do just a flexible budget right now. On Wednesday, I'm going to come back and we're going to actually try to do as much of an entire performance report as we can, because that's going to be your graded assignment for this chapter. Okay, so I'm on page 412. Notice I already kind of have some of this up here. This is exercise 9-1. Okay, we'll get it done so you guys won't have homework other than the chapter 8 stuff you have to do. All right, it says Puget Sound Divers is a company that provides diving services such as underwater ship repairs to clients in the Puget Sound area. The company's planning budget for May appears below. All right, so when do you think they would have done the budget for May? Sometime when? Sometime in April, right? Sometime in advance of May, trying to just estimate how many hours of diving they would be providing to their clients. So notice here, this planned budget is done for you. This is the planned budget. It's been created. What is it based on? How many diving hours? 100, right? Q is 100. So in April, they expect to provide 100 diving hours. Now, they're going to determine what they think they're going to earn, their revenues, and some of their expenses based on those 100 hours. So look, revenues, they charge $365 an hour. So total revenues would be 365Q, in other words, 365 times 100, right? That's where we get the 36,500, okay? I know everybody's writing that stuff down. Can you just wait, make sure we know where all these numbers are coming from first, okay? Then we have all of our expenses here. Wages and salaries, 8,000 fixed expense, right? Plus 125Q. So what do we have to do? We have to take 125 times 100 first, right? And then add 8,000. You get 20,500 that way. Supplies is also based on Q, so $3 times 100, 300. Equipment rental is mixed as well. So we've got a fixed and a variable component. Insurance is fixed, and then miscellaneous is also mixed, right? So when it's all said and done, we add up all of the expenses for this diving place. You get $30,010. Revenues of 36,500 minus expenses of 30,010. They expect or plan to have income of 6,490. Okay? All right. Now, the month of May comes and goes. It's May 31st, end of the day, and the owner says, I wonder how many diving hours we actually provided this month. I don't have all of my expenses and receipts, and I don't even have all my customers necessarily billed yet for this month, but I can count the number of diving hours that I provided in the month of May. And if we read down, it says, during May, the activity was actually 105 diving hours. So, should this company wait to get the actual results and compare them to the 100 diving hour income statement, or should they update this income statement and change all the numbers based on that new information of 105? What do you think the answer is? We wouldn't have an assignment to do if we didn't have to change something, right? So, yeah, I wrote this up here because now instead of 100, what is our Q going to be? 105. So I'm going to take and I'm going to plug 105 back into my formulas where appropriate, and I'm going to adjust or flex my budget, right, to agree with the level of activity that I actually incurred. And then I'm going to compare this new flexible budget to my actual results when they come in. Okay, so all you have to do is get your calculators out. That's it. That's not hard, right? We've got 5 minutes left. Let's get this done. So how do I find out my total revenue? $365 per hour times 105 hours, which gives you $38,325. All right, that's your total revenue. That's not too hard, right? Everybody understand where I got that number? You good? Okay. Now my expenses, and I even started writing some stuff down here for you. Wages and salaries, I got lazy, I abbreviated, sorry, is 8,000 plus 125 Q. So we got to do the 125 times Q first. Q is 105. So you'll notice I even wrote it here. 125 Q, or 125 times 105 is 13,125. Then we add the 8,000. So that gives me 21,125. Everyone know why I did that? Order of operations, right? Okay. Supplies is 3Q. So what's my total supplies expense? $315, right? Just 3 times 105. Anytime you see Q, you guys remember algebra, right? Just multiply. Even though there's no multiplication sign there, that's what it means. Equipment rental, 1,800 plus 32Q. So 32 times 105 is 3,360 plus 1,800 is 5,160. If you don't know where I'm getting a number, please say so I can explain it. Make sure you at least put that calculation in your own calculator one time so that you don't, so that you know how to do it, okay? What about insurance? Stay the same, right? Because it's fixed. How do I know it's fixed? Well, there's no Q there, right? And even if it were to change at the end of the month, it wouldn't be based on diving hours. And then miscellaneous is mixed, so we have a $1.80 Q, so $1.80 times 105, which gives me 189, plus the 630 gives me 819. All right, now, I need you to add up the total expenses for me from 21,125 down to 819. If somebody has that number, I'll take it. $30,819. All right. Now, we take our revenues of $38,325 minus our expenses of $30,819, and we get net income of what? 7506. And so this is the information we'll use to compare to our actual results when they come in. And we'll carry this on to Wednesday. Everybody understand the difference between the planned and the flexible budget? That's important. It's the activity level. Then the difference between the flexible budget and the actual results are not activity levels. They're the same. Differences in costs, revenues, and costs. Okay? You guys have any questions? All righty, we'll see you back here on Wednesday.